Season's greetings, everybody. Welcome back into Mining Stock Daily. This is this week's and this year's last long-form episode on the podcast. It has been, I guess you could say, an eventful year. Markets were not great, but we continue to tell as many of the stories from the bush and the exploration field as we could. A special thank you for our partners, Western Copper and Gold, Arizona Sonoran Copper, and Fireweed Metals for their continued support of the podcast throughout the year. And special thank you to you, the listener, for tuning in. We are wrapping up the year with a big episode, and it just got bigger after this week's, I guess you could say, Fed pivot. We're done hiking interest rates, as Jerome Powell says, and in fact, they're going to be looking at cutting at least 3 times next year, and the markets responded in incredible fashion yesterday, you could say, including precious metals and the precious metals equities. So we're going to talk about this with our good friend Tony Greer from TG Macro in this week's long-form episode. And then we're going to conclude the year. Got some special entertainment for you at the end of this podcast episode, so do stay tuned for that. It's going to be a lot of fun. All right, let's jump into our final long-form episode with Tony Greer, and we'll talk to you at the end. Have a magnificent holiday season, everybody. All right, everybody, welcome back into our final installment of Mining Stock Daily for 2023. What a day to be recording, as we are recording this on December 14th, the day after the Fed pivot was announced by Santa Claus rally Jerome Powell yesterday. And our buddy Tony Greer, who better to bring in as our final guest of the year than somebody who called this bull rally a couple months ago, actually. Kudos to you, Tony. But hey, first, real honest business. Like, what's the cookie count, Christmas cookie count looking like in the Greer household right now? Is it like dozens?
Oh, it's going to be a fruitful Christmas around here, Trev. It's going to be a fruitful Christmas. It was a great year in the markets, and we're going to make sure that we celebrate at the end of it. You know that. That's for sure.
Yeah. I have no doubt that the Greer household is going to be partying for the next 2 weeks. Hey, man, listen, we're going to talk a lot of things in this final episode. Obviously, kind of a year wrap here. I mean, there's a ton of volatility, a lot of head fakes that's going out. We're going to get your thoughts here on 2024. And basically, I mean, so many things changed yesterday with Jerome Powell and the FOMC putting the line in the sand that the pivot is here. They put out basically their dot plot of expecting at least three cuts into 2024. We're going to talk about what that means. The market is expecting a little bit more. So obviously all of that things. But listen, I got to give you kudos. You were bullish months ago. And I told you, back and forth even a couple weeks ago, I was like, I don't know if I'm buying this yet, Tony. Like, they're saying higher for longer. I think the market's fully ahead of themselves. What were you seeing on the tape where you were like, nah, we're going long?
Well, Trevor, thank you for noticing, because it's always nice when people notice that you make a good call, because the business is all about, sticking your neck out when you feel the time is right and trying to help people and sort of influence their decisions if you feel like you have an edge, right? So, I was it's interesting that how the bullish case evolved, but when I was bullish months ago, it was sort of based on the fact that we had sort of just sold off and adjusted to the scenario in the Middle East that was scaring the crap out of everybody and the markets. And what else did we just adjust to? I think it was probably just the fact that the Fed had probably, sent some signals about having inflation somewhat better under control. And so in that scenario, that was like we were coming into a Fed meeting, the market had sold off, we were into 200-day moving average support in the Qs and S&P, for God's sakes. I think we were directly into it in the S&P. And we were coming into another FOMC meeting, and I was like, everybody's negative down here, and I don't think that Powell is going to say anything that's going to topple the market over from here. Rather, I think he might rescue it. So that's when we got first signals of sort of potential pivot, and it started out like it usually does, right, Trevor? Like kind of fading the bearish sentiment bubble into support, and sort of having a little faith in the fact that the people that control money supply and interest rates are going to figure out how to engineer, a recovery in the stock market. And so then we rallied into, I was pretty clear, I think on it was November 14th, when we got the last CPI number and the S&P gapped out of all of the resistance levels and just took off and started galloping. That's when I came out and said CPI was benign, just buy stocks. So with that, on that day, back on November 14th, we got a CPI number that was directly in line and the market went berserk. There were 2 sigma sell-offs in the dollar. There was a 2 sigma treasury rally, and there were 17 sectors of the S&P that had 2 sigma rallies, which is just like a waterfall macro day. And if you paid attention to that day, my call back then was the market just sent a message. CPI came out in line. The market decided that inflation is not going to be a risk going forward. Like that was the last straw that convinced the bond market that there is not going to be a need for dislocation lower, spiking rates higher. And portfolio managers left higher marks all over the tape, right? It was like, oh, okay, student body into the equity markets. And then yesterday, Trevor, was like a carbon copy. It was the same exact thing. We got through CPI. It was kind of the same thing, but in 2 parts. We got through CPI on Tuesday, which said another consecutive month of snoozer CPI in line, 3% year over year. It's on its way down. Bonds don't do much, and stocks pick up, and they're like, got it. As soon as the FOMC clears and we're not going to have any surprises, it's up and gone. And so that's what happened. We got to the presser. Powell came out dovish once again, like you said, inclined to lower rates. And this is what we're left with. So it's just a continuation of those moves. So I don't want to take up the whole podcast and not let you chew apart my thesis at all, but that's how it came together. And that's where we are.
Well, let's talk about where we're at. Obviously, the Fed pivots to very dovish. That's been known for the last 24 hours or such. But the technicals, listen, you're looking at charts as a trader. You're seeing extreme bullish sentiment. You're seeing overbought, measures on almost every major chart here. The S&P is very close to matching that all-time high. Things are getting so technically up there that it almost needs to cool off a little bit. But let me ask you this, does this cool off, is that just if it comes back down, is that just a healthy correction here, or are things kind of lined up to where we could see yet another head fake and a windfall down?
Well, I love the way you present it, Trevor. So the way I'm looking at it is, I think that we're in what's called a little bit of the plastic bubble right now.
A plastic bubble.
Yeah, the plastic bubble, like the boy in the plastic bubble, the movie that's from, like the 70s. But we're in this plastic bubble now where we just got confirmation. Like there was some buildup and stock rally because CPI went benign for 2 months. And so things got better. And then we just got to the point where Powell actually pivoted. And it's like, yesterday the market responded to that. And what's eerie about the timing right now, right, is that just as we're getting the news from Powell that he's about to reverse course now and start easing, we're also seeing liquidity conditions in the market pick up, right? Michael Howell at Cross Border Capital is your expert in that field. He's seeing liquidity start to expand in the markets, right? So that improves conditions. That's a risk-on signal. All of this took place as the S&P and NASDAQ totally erased the divots from last year, right? There's a mental condition to that where, if you say you did nothing over the last several years, you're long the NASDAQ, you come in last year, you get walloped, the S&P down 25%, NASDAQ down 35% or whatever it was, right? You wade through this whole year, right? At some points, you're more underwater. At some points, you're back in the money, mostly underwater. Now, all of a sudden, towards the end of the year, you get all of last year's returns back. Psychologically, that's a big tailwind for the markets, and people don't give that enough credit, right? So now, people are looking like, oh, it's the end of the year. It's like, no, it's not the end of the year. It's the beginning of the next leg, because we just got all of last year's losses back, and the Fed just officially pivoted. And now stocks can rally. I don't care where they came from. I don't care that they just bounced however many 100 points. I don't care. Now we are changing cycles, and stocks can rally. Now, there's going to be, you bet you, now you nailed it at the beginning of your last question where, technicals, stochastics, and over an RSI, oversold to the max. Overbought to the max, right? CTAs, limit long. Bull index, pinned. Greed, right? Fear and greed index, pinned to greed. So what are we set up for? We're set up for a scenario where bad economic data will probably cause a spill in the S&P, which will eventually be met by signals of lower rates, because that's the way he just showed the way. He's getting ahead of the bad data that's going to eventually come out, where the market's going to get rocky.
His timing is very different than it's been in the last 3 years.
Bingo. He's finally a little bit ahead of the curve, where if you notice that when the inflation bug came out, it bit him in the ass, right? Like Powell was having meetings with Biden in the beginning of the administration, because Biden knew that he just blew the lid off of the freaking inflation. When, first of all, we had the pandemic doubling of the Fed's balance sheet, right? That was at the end of the last administration. And then we had Biden come in, take office, and start talking to the Fed like 9% inflation, fix it. Right? And that's kind of what happened. So that was a big problem for Powell. And I said, for me, that's when he was like, sounded like he had a gun to his head when he was coming up at the FOMC meetings, right? He was quivering, he was nervous. And that was like, the battle of getting inflation from headline 9% down to 3%. And he was very much behind that curve because he didn't see that spike coming that was due to the political changes that took place, the executive orders from day one, And so now that he got to digest that and got back out ahead of things, he's back out to playing his own games. Yeah, we're easing. Oh, yeah, easing central bank. I know how to do that. And the stock market takes that as a signal like, okay, tech stocks up and gone. Right? We got the AI tailwinds. You've got software screaming. You've got semiconductors out ahead, up 70% year to date. We're set up for Santa Claus rally right through the end of the year.
Yeah. So the other side of this, Tony, I mean, I felt like I've been saying this all year long. Like, I get the bull case, I get the bear case. David Rosenberg came out and said the FOMC's nominal growth projection of 3.8%, that thing stinks of recession. And then Peter Bookvar, our man Peter over at the Book Report, he had a great note this morning where he kind of equated this week's dovish pivot to remember what happened in the second half of 2000 as the Fed was shifting to rate cuts, and we know what happened to the market after that. Again, rate cuts leading up into the COVID dip and recession into 2020. Rate cuts going into 2006, 2007, a time period I know you know very, very well. So what I want to make sure is, yes, I mean, you can make, the Santa Claus rally here, but Christmas is going to be over in 2 weeks. We got to remember financial history here. So just because the Fed turns dovish doesn't mean our head doesn't remain on a swivel.
Correct. Totally fair.
So, yeah. I guess that's a question, I guess. I mean, like, what is your bearish case?
Yeah, well, put it this way. Let me give you the scenario. I think that we're set up to be very much in like a 1995 scenario. 1994 scenario where, and I think it was 94, that the year that we had sort of a negative year in the stock market, which was because the Fed was trying to slow down the rapid GDP growth and inflation that we had just seen at the end of their rate cutting cycle, right? So they cut rates, they spurred the economy, inflation picked up, and then we got to 94 and they said, whoa, we got a little ahead of ourselves. We got to raise rates a little bit, right? And then 94, stock market returned minus 2% S&P or something like that. Then it came out of that. What happened was Fed funds were in a 75 basis point range for 2 years after that, right? So what happens? The Fed comes out and says, we're going to have to tighten to slow the economy down. They go ahead and do that. Then the economy says, okay, now we're caught between economic growth and a little bit of inflation. So the Fed never gets a chance to really move rates far in either direction, right? Because you've got the sort of inflationary forces that want to push rates higher, but you got this kind of drag from the economy that's saying, yeah, but there's no you can't hike rates with the economy here. Now, if inflation doesn't fly under control and the economy doesn't go into an utter collapse, just the expectation that the Fed can loosen if they want to, but Fed funds stay in a close range, that is a scenario where stocks can utterly roar. And that took us right into the dot-com bubble where in 95, 96, 97, 98, there were double-digit massive returns in the stock market, that we blew a bubble with. But the same thing happened. We just adjusted to severe inflation, total overheat, right? We coming out of that now, and I'm like, the Fed is saying that we're pivoting now towards lower rates. Well, in my opinion, inflation's never going to let them lower rates very much, and the weak economy is never going to allow them to really have a posture towards tightening either. And the stock market's going to be like, no change in interest rates, twos at 4%, 4.25%. We can live with that. No chance of a dislocation lower with all of a sudden inflation comes flying out of the gates again, because it doesn't seem like that with the way commodities are trading in a bear market, right?
Yeah.
It seems very much with the commodities in a bear market, inflation bottled up, Fed funds likely range bound with a couple of forces on either side. For me, that's get up and go for stocks.
But the yield curve is still an absolute disaster right now, Tony. I mean, so how do we make sense of this?
Yes, it's really difficult. So that's the scenario that plays back into, let's just remember and bring back full circle here, because this is the great type of conversation like Joe Rogan where we can do that and sort of slow things down a little. So like you said, things are overbought, CTAs are long, sentiment is bullish, right? What's eventually going to happen is positioning is going to get way overweighted long. We may be getting close, but I don't think we're really there yet. And there's going to be some negative news to come out that the market's going to have to deal with, right? That is going to catch positioning off guard, and the curve is going to start steepening because it's going to see trouble ahead, right? The steepening of the curve, especially if it happens rapidly, the VIX is going to pick right up out of this hole that it's in, right?
There's your 2030 spot we haven't seen in quite a while.
Yeah, exactly.
Yeah.
And so, but you know what though, Trevor, like something like that doesn't happen until after this thing puts everybody to sleep 10 bit of 12. Like we're not there yet. Like these things are just, the machinations have just happened, and it's like we just got last year's losses back, and like this is even though it's the end of the year dynamic, it's kind of the first inning of a new ball game. We're not tightening. We're not easing. The curve is minus 50 basis points, and it's not really doing anything until the economy gives it a reason to steepen, which will mean that twos are going to come crashing down, right? Because they're going to start pricing in another cut or something like that, right? And so that's going to be fine for the stock market, And so, but what we're going to see is when we're going to get the waterfall finally, when positioning gets a little bit more over its skis, and we get that bad economic data where the curve starts steepening towards the zero boundary again, and the VIX picks up. But that dip, because there is no fear of a serious spike in interest rates, that dip is to be bought. Like, I get it. People are going to get long. The last guy's in, have to lose money. It's the same story every time. I'm totally fine with that. There's got to be a big slide of the negative S&P days when the VIX gets compressed eventually. I get that, and it's going to happen. But where's it going to happen from? If we're in this, like, sort of plastic bubble that I'm calling it now, where kind of everything is just fine, right? If nothing disturbs this bubble, this is where stochastics stay overbought. Sentiment stays positive, and all the people that piled in on the long side turn out to be right. And the market goes higher, and then we get to 5K, and then we have your 200-point spill.
Yeah.
right? And then we're at 4,800.
Right. Well, okay. So here's where we're at. Tony, listen, most people listening to this right now, people like you and I, like we will know how to profit from this, and you've done a great job of showing your subscribers on how to profit like this early, before this big move we saw in the last 48 hours.
Thank you.
But on a general societal picture, the big picture of America, how does this benefit us? I mean, people with assets know how to maneuver with this and continue to profit. But you and I both know that the lower to middle class in this country continue to struggle. Eggs are still up 20% month over month. So what good is this going to do for the rest of the country?
Market doesn't trade on the egg price, Trev. I hear you, and that's, we have to sort of divide that conversation.
Sure.
Because I you know what I mean? Like, it's like I want to be as sympathetic to that as you do, but I have to grow up in this world. My kids have to grow up in this world too, as do yours, as do theirs eventually. And so, yeah, I can have a real concern for that, and that conversation of, the literal disappearing of the middle class. I mean, it's been pretty clear as daylight. That the rich are getting extremely richer and the poor are getting much poorer, especially with this, inflation bite after the COVID pandemic lockdown, the lockdown bite, that economically took its toll on everybody that had their own business and et cetera. And so those conversations have to be separated, because the market is just going to trade on the same BLS data that it's been trading on. And as you can see, the government has done an unbelievable job of separating that data from reality.
Yep.
And that's sort of something that we don't get to have a say in, and so, like, I kind of make fun of people when I see them on the internet saying, oh yeah, the data came out this, but that's bullshit. Right? It's like, the data out of China is bullshit. And I'm like, no, I know, and that's fine. But the market doesn't care. The market's not trading off what you and I know, and it doesn't care. You know what it's trading off? The face value number that just came out. It just took it at face value, whether we like it or not, whether it was fake, real, or whatever. The market took the number at face value, and it's trading off of exactly what that would have been.
Mm-hmm.
So it's like, there's nothing you can do about that. We have to figure out, the societal issue is one thing and the market issue is quite another. So that's all. I just have to express that. That's all.
And the reason I asked that is because, yesterday, obviously, like, I'm watching these market moves on the back of Jerome Powell, and I'm buying just a couple QQQ calls just to have in my pocket to trade and sell off just for a little bit of profit, which is, what you do when you're active in the market. Why not? And I'm seeing my gold equities finally get a little bit of a buy. I mean, we're still not back to where we once were, but at least it was a healthy, big breath move. But at the back of my mind, I'm like, this is nowhere even close to a Paul Volcker move. Nowhere close. It's not even close. And so I'm just kind of wondering, if you look a year or two down the road here, if we don't find ourselves in a similar situation that we were in 2022, with inflation running hotter than they want it.
Yeah, you can't put 9 trillion of balance sheet back in the bottle, right? You can put the inflation back in the bottle for a little while with interest rates, but you can't put the dilution of your currency, at the level that we did to M2, increasing our money supply 40% in 1 year due to the lockdowns, you know what I mean, in response to the lockdowns. That is not going away. And so I absolutely could be in that scenario where we do run into a bit of a stagflation issue. And that'll be quite different than what we're seeing now, because, Trevor, you're going to have to show me a commodity rally to say, hey, look, we're getting back into that problem again, where the commodity prices are going up and the market's going to respond. And it's like, okay, but the BCOM has been in a downtrend since the Russian response to NATO's invasion of Ukraine, right? So since oil traded 135, commodities have been in a straight trend down from the top left to the bottom right corner of our screens. And now that we're pricing in no longer an inflationary scenario, but a deflationary scenario, commodities are just pricing that in now.
Yeah.
right? So that's another leg down. I mean, you're better at base metals than me. Does the price action look good to you?
Well, I will say that the metals ETF, the XME,
Yeah, 100%.
it looks pretty good. It has broken out of like what I called on Twitter a couple weeks ago. You were teasing me about the long wedge, but it has broken out of that. It's trading at 56.64 now. That's the highest it's been since earlier in the year. Looks pretty good. Copper, having a pretty good move here. I mean, yeah, we'll see. Listen, a full-blown recession will put all those things in check right away. Day one, boom. So we're yet to see it, and that's always been my ongoing concern with the base metals complex. And so maybe we'll talk about precious metals and the monetary aspect of that too, but I do think that this is a good move for base metals, specifically copper. It's a good move for the XME. I just, kind of, I don't know. I'm not all in yet.
Yeah, no, yeah, exactly. It's hard to be because we just lived through this scenario where we were pivoting to electric batteries. There was no supply of copper. Copper was backwardated to the hilt, and the price only went down.
And Ford cuts F-150 Lightning production in half.
Right, exactly. Ford cuts F-150 Lightning production in half, and the price gets fucking thirded on the LME. Right. So we're like, wait a minute, what happened to no copper? What happened to we need all this copper for the battery power and everything? Like, that trade just fell flat on its face. And I just wanted to comment. You mentioned the XME. I did not really count on that responding to this pivot like as strongly as it did, so like gold had a decent performance. Gold went from 1980 to 2030, so a $50 rally on the idea that we're finally going to pivot and actually cut rates. And copper went from 8,300 to 8,550 on the LME, but it's still like all the base metals to me are just like trying to get back up towards resistance. Right. Like the trends are kind of down, and it's going to be hard for me to get excited about them. But XME took off because of gold, and gold stocks took off with this gold move. So we'll see if that can continue. But I guess you're right. Gold does look better. The miners look better. We're going to see how the whole commodity trade plays out from here.
Yeah, well, you do have gold on your view matrix on your Morning Navigator newsletter. That's been up there for quite some time. TG, you also host our Oil Ground Up podcast on the Clear Commodity Network, and I appreciate you for all that work this year on year one of that. But it's been, the oil market's been a wild ride. We come down from grace from that 130 level, now $72.60 a barrel on the WTI futures. Where do we go from here? What's oil telling you right now? Are we in an okay spot?
What we are now, Trev, is really a fun place in oil, right? It's called the forbidden fruit trade, right? Let me go into that scenario for you right here, okay? So oil spends all summer, March, April, May, June, bottoming around, so the spring, bottoming at literally right where we saw the lows this week, around $68, right? So from the spring at 68, $70, oil trades up to 95 during the Middle Eastern conflict in October, and then trades straight back off to that range bottom that held in the spring, right? Yeah. The inclination is to be like, ooh, give me some of this back here at the range bottom, right? Like we're into support, it just fell $20. The forbidden fruit trade, though, happens when the market says, that's nice that we're at the range bottom of $70. I'm still pricing in deflation and economic slowdown and plenty of oil inventory. And suddenly you look up and oil's 55 offered. And so I feel that there is a definite, distinct possibility that that is the case. And only because I don't want to be accused of being a perma oil bull, because I'm not. You know what I mean? I'm a chest-beating bull when I'm bullish, and when I don't have a view, I have no position on like I do now. I have no risk in any energy whatsoever. I see no trade, no opportunity, but my eyes are wide open, man. If this thing falls through $68, $70, There's going to be a lot of bulls that are going to be in a lot of pain, and there's probably going to be a great freaking trade on the short side for 10 or 15 bucks.
Yeah. Well, with there's no opportunity in the oil trade, that might present an opportunity somewhere else. And I was reading a note from Canaccord Genuity last week, I believe, and they were talking about 2024 kind of expectations, specifically for gold miners. It was a terrible couple of years for gold miners. Margins were being cut for a number of reasons, including higher costs, energy and oil being the biggest line item on anybody's balance sheet if they're producing gold. But they're expecting gold price to somewhere between 2,200, 2,300, and with expectations that the oil price would kind of be right where we're here now, $70 to $75 a barrel. That would improve margins on gold production for the year. So that was, obviously one of the big brokerages analysis for 2024. That looks pretty positive. That's something I could probably swallow and tend to not, disagree with. Like, do I think gold's going to be at 2,300 by the end of 2024? Well, after yesterday, I think that's a very conservative position. I think we'll see gold a lot higher. So, but just thoughts on, let's talk about precious metals. Let's talk about gold. I know you've been bullish for some time. What about the gold miners? With what I just laid out there, what are your thoughts on gold mining right now?
I mean, gold miners are sort of a little bit of a microcosm of the S&P, where they kind of just went through a 6-month period of struggle, where gold was deciding whether or not it was going to break through this 2,100 top or not. And so the miners really, really struggled with that as gold failed. Now gold finally breaks through, and miners finally traverse from the underside of the moving average band to the top side of the moving average band, right? So they go from 26 to 32, and that's after coming out of, a really, really struggle period from June, July, August, September, October. It was range bound 26.30, really an offered beat up sector that is still, down on the year, I believe. Is it? No, it's up 10% on the year, excuse me. But it was down on the year for a little while, and or it was almost down to single digits. So they've weathered a really tough time, and in my opinion, gold is looking more and more like it wasn't a total blow off top when it broke through the 2080 range and traded up to 2150. It feels very much like that. The back off from there was pretty shallow. Unfortunately, there was no symphonic buying up there of follow through of CTAs or new positions that said, hey, we got to get this thing on the books. Right. That would have been really nice if we saw some money come off the sideline and say, on this side of 2,100, I got to be in gold. That never happened, right? So what I think happens is you go back to the same scenario that gold was in, where it's just a slow, grinding, physical, depleting, slightly better price action market, where the dips are shallow. Everybody's trying to get a hold of some. There's fiat currency weakness and blow-ups left and right everywhere you look. And you're like, yeah, gold's rallying and Bitcoin is rallying because there's massive distrust in this system. There's weak currency links, there's weak bank stories here, there's situations here and there, and the alternative currencies are rallying. So I think that with that and the tailwinds of central banks buying, Trevor, the one thing that I don't think gets talked about enough is that if there is this massive divestment from U.S. treasuries, from foreign holdings, which we've seen, right? China selling, Japan sold, Russia sold. If that continues, they're going to look to put something else safe on their balance sheet, right? It used to be the flight to quality, the flight to safety in U.S. treasuries. That clearly is not the case 3 years into a bear market, right? Like half the people sold them, the other half are like, oh my God, should I replace my treasuries with gold?
Yeah.
No, literally, I think that's what's taking place, and I think central banks are doing that. As they divest from treasuries, they're like, okay, let's put gold on the books. What else are you going to put? Another paper currency?
Yeah. Well, the supply of U.S. debt is still going to come online. Who's buying it now?
Yeah, it's a much tougher sale right now that inflation is a real risk, and so I couldn't agree more. I think that there's I think we could stay in a bearish bond market, even though the scenario feels pretty good for bonds to rally back quite a bit. I mean, that's okay. We've been in a 3-year bear market and we're bouncing off the bottom. So, like you said, where inflation can creep back into the picture, we could absolutely be in for a short regime here where rates can fall and everything's under control. And then next thing you know, gold percolates, natural gas percolates, the picture changes, and, rates have to adjust back up again. And you have bonds sell off. So, I don't have a strong view on the bond market down here. Like, I feel like the path of least resistance is probably higher in the short term. We definitely saw some signs of bottoming in a massive negative sentiment, bear sentiment bubble in the bond market, where like my mother-in-law was checking on the auctions,
Wow.
and you're like, excuse me, yeah. Yeah, so things like that are going on, and you're like, oh, let me just be flat treasuries here, like I have no opinion, man. So, yeah, it's going to be, the whole thing is going to be a bar crawl in 2024, both the stock market and the bond market.
A bar crawl for 2024. That might be the name of this episode.
Yeah, let's call it.
I think one of the most eye-popping moments of this podcast all year was my interview. You mentioned Michael Howell a little while ago. Was my conversation with Michael Howell in Frankfurt about 3 weeks ago. And he's talking about liquidity and the amount of debt supply that's going to need to come online for the U.S. government to remain solvent. And he mentioned the same thing you did. Well, if China and central banks are not coming to the table to buy that U.S. debt supply, who will be? And he basically laid out the thesis that the Federal Reserve will be the first and last buyer of all U.S. debt supply coming online. In fact, he mentioned in a chart, I believe, I'd have to go back to it, but this number, $8 trillion of buying by the Federal Reserve of U.S. Treasuries is in his purview. What does gold do with $8 trillion of debt purchases by a Federal Reserve?
Sweet Jesus, it ain't on a 2000 handle anymore, is it? Right?
No,
you can't imagine that scenario is a total, it's an outlier in thought process right now. Like, the market won't hear of that right now, but man, you have to, that's a non-zero possibility, and probably bigger than that if I ever heard one. So, in that scenario, the game changes dramatically. I mean, the dollar could be, have a real problem versus other currencies in that scenario. So that should be extremely bullish gold, man. It's tough to tell.
You'll never see 3 digits on a dollar, on a DXY under that scenario. Not even close.
No. That thing probably get dunked to 75, 80, right? If something like that happens at best, right? I would guess. I mean, that's a big deal. That's a very bold call at the same time. So we have to see, that has to happen first. But I do appreciate the way Michael looks at the market and all of his views, and he's always super helpful to me. Especially, he was giving us a signal. He was another reason to be bullish, when the markets were sort of coming off moving average support. He was saying, be careful out there because liquidity's picking up here, and the bears just got run over.
You and him had the same call like back in the spring this year.
Yeah,
totally. I remember that.
Yeah. He was a big influence on my call because I don't think any people weren't paying enough attention to that. So
yeah,
we'll see.
Let's talk about next year. 2024 expectations. God damn it. We're having an election, which means I'm just going to want to stick my head in the sand. It's going to be a real hard. It's going to be a real hard one to kind of get through. TG.
It's going to be MAGA versus the Swifties. Look out.
It's going to be.
It's going to be a hellscape. It's going to be an American hellscape. I'm not looking forward to it.
A part of me wonders if that pivot this week was part of preparing for that. If it was political.
Could be, man. They emptied our SPR to be political. Why wouldn't they shift interest rates around a little bit, right? I mean, that seems like a totally plausible scenario. Maybe wanting a strong close to the stock market and cheap gas prices. If they're looking for that into next year, we're sure set up for it, right?
I mean, listen, you are the optics of this whole thing. If you are not a person working in finance or playing in the markets, the optics of this look okay, other than the cost of things that you need to buy, like food.
Yeah, that's for sure. And unfortunately, that is just going to quietly bury the middle to lower class like a slow drip.
Right. Yeah, I agree.
That's just how it's going to go. The Loch Ness monsters that are out there, meaning like our 30 something $trillion deficit and the $1 trillion or what is it, $1 billion of credit card loans,
Delinquencies,
or however many billion
bankruptcies,
exactly.
Bankruptcies are moving up higher. I mean, they've broken out. It's not pretty.
No, it's not. But you also have to differentiate between that, the reality, and the markets. Because if you look at those numbers and expect the markets, like I call those numbers, like those astronomical numbers, like our $34 trillion of debt, that's a Loch Ness monster, right? Like you can sit here and be upset about the $1 trillion of debt and get bearish stocks, and give your whole entire life, career, and opportunity away, right? If you're sitting here worried about our deficit, because that's just not the way to make money. You know what I mean? Like that's why I call them Loch Ness monsters, because they're big, unbelievable things that the market just doesn't see. So if you're going to stand there and stare at them, you're playing a different game than the market's playing. That's all I'm saying.
Yeah.
It doesn't matter until it matters, right? Yeah. Good.
Right. You're absolutely right.
That's all.
All right. 2024.
Yeah. So
what do you think? How are you playing this? I mean, other than continue to let the bull run down the New Jersey Transit.
Yeah, exactly, man. Up the Long Island Railroad. The 2024 to me is gonna be the push and pull between weak economic data, a little bit of adjustment in the curve higher. Stocks are going to be okay because Fed funds are going to stay in a super tight range. Always going to be a dovish bias where, hey, this economy gets any weaker, we're going to ease. So we're going to have Fed funds in a super tight range. We're going to see equities rally. It's going to be, I think they could rally at least for the first half of the year. I mean, it's going to be a bar crawl, like we say, Trevor. There's definitely going to be, because the scenario is looking better and better for U.S. stocks. It's going to be the scenario where it gets overly long and overly bullish and then backs off. And then there's no reason for a crash, so the trend remains intact, and then we get overly long and overly bullish, and then we pull back. And so that scenario still, to me, ratchets its way higher. So I can be an S&P bull next year. I can be a little bit of a bond bull next year. Commodities, I hate to say it, but like I'm a trend follower and they're a bearish trend and the trend is your friend. And I'm going to say that they're going to get cheaper still next year, especially coming into an election. Like I just don't think that he's going to let the price of gas fly up towards 350 again or anything like that, just to kind of keep it out of the news. That's probably, the perfect scenario for them. So I can't get bullish commodities. And I just think rates are going to be range bound enough to the point that the stock market is going to have a good year with some AI tailwinds and hopefully some upside surprises. The risks could be in, more bank blowups like we saw with SVBI. Maybe there's another cockroach goes belly up or something like that. It doesn't seem like that's the case, but I don't know if all of the damage done by that rapid rate rise is, out of the markets yet. So I'm kind of still just on the lookout for anything like that could happen. And so it's going to be a tough year to battle through, but I think that it's going to be really interesting coming out of this year. And, this year where we got back all of last year's equity losses, and where are we now? And the one thing that I will say about the election year is that, I feel like one of Biden's number one black eyes is going to be the border. And so if it becomes obvious that the border is presenting a problem into next year, like it's sort of bubbling up in New York City and kind of all around, that's going to be harder for him to poll well. And especially if there's like an impeachment proceeding, if the thing with Hunter gets more serious, he's going to get removed from being the candidate. And it's going to wind up being like the sort of less ugly candidate on the left, probably Newsom, obviously, if he's meeting with Xi Jinping, and it's going to have to be him against Trump, right? But if Trump starts polling ahead of the left, way ahead, because, the world's not happy with the border situation, because whatever they didn't like about Biden, they want to change, whatever it is. Tell me how bullish that could be for the stock market if under the first Trump administration, we had $1.85 gasoline and soaring stock markets because of lower interest rates and lower regulations.
Mm-hmm.
And that party starts with the S&P at 5K.
2025, man.
Yeah, I mean, I'm just
And
saying.
I mean, if that does play out, I mean, if it does play out, I mean, it's going to be getting there is going to be incredibly ugly. I'm not looking forward to it.
No, me neither. We're in the same boat. We're probably on opposite sides of the spectrum, and that's fine. But yeah, it's going to be really, really brutal to get through. I'm not looking forward to the headlines that we're going to see next year. It's getting spooky on the internet too. If you like you see that,
yeah,
right? There's like a Civil War movie out. The Obamas just did this crazy Netflix movie where there's a blackout nationwide and things like that. And there's all this talk of predictive programming. And like that used to be stuff that you couldn't even talk about in public. And now people on Twitter are like, look at this. What are they planning? You know what I mean? And that just happened because they did this, exercise before COVID. And 3 months later, we had a global pandemic. So
remember,
everybody's like...
Contagion came out a year before COVID, or maybe it was a year. It was just like fascinating. It's like, why am I watching this, and why am I watching this now?
Right, exactly. And there's 8 billion people in the world now saying, "Fool me once, shame on me. Fool me twice. I mean, fool me once, shame on you. Fool me twice, shame on me."
Right.
And I don't think the world's going to get fooled twice again, but we're going to see how it plays out. It's going to be a bitch to get through.
You and I will definitely be talking throughout the year, obviously. It's not going to be the last time we hear from Tony Greer.
No, we're going to stay close.
Yeah, buddy. All right. Hey, thanks so much for your time. I'm super glad we could wrap up MSD of 2023 with you. You are the man. Thank you so much for everything you do for us and the listeners. And everybody can go to tgmacro.com for an idea of where you can get his Morning Navigator and all the other products that he provides for his subscribers. TG, thanks.
Yeah.
Man.
Yeah, Trevor, thank you. I just want to take 1/2 a second of your time and say thank you for, the opportunity to cover and man the Ground Up podcast, the Oil Ground Up podcast for Clear Commodities. And that's a side project that I was sort of hesitant to take on, but wanted to help at the beginning. And it became something that I really, really enjoyed doing. And now we're just we're kind of just forming our stride with that. And I think that, with the attention that we'll continue to give it and the love and care that we continue to give it, I think that's going to turn into a pretty interesting program, or at least I hope for it to be. And I'm going to work towards that next year.
Yeah, for sure. No, it's been a lot of fun to see that grow along with the other podcasts and content we've been putting out through the network. Tony, Merry Christmas. Best holiday seasons to you and your family. We'll talk to you again in the new year.
You're the best, Trevor. Good luck in the new year. Love you, man.
Love you too, buddy. All right, everybody. That's a wrap here for 2023 on Mining Stock Daily. It has just been a whirlwind of a year. I believe this was the 6th year of the podcast, maybe 5.5 if we're being specific. And it's just been a great year despite the volatile market. So I have a lot of people to say thank you to. First, I got to say thank you to Mr. Paul Harris for being my right-hand man here many times when I couldn't make it to the microphone. Just enjoyed the mornings. We've done the morning briefing together. He adds quite a lot to MSD when we can. It's just a wealth of information. Happy to have him on board. Special thank you to Carla for everything in the background and the marketing and material, and also with the kind of strange requests I have every once in a while. You are the best. And Ted and his team over at the Junior Mining Network, love the partnership. Thank you so much for being such a strong partner of MSD throughout the years. And on the Clear Commodity Network side, it's been the first full year of ClearCom, and we've launched a number of different podcasts within the resource sector. So Tony Greer, TG, who we just spoke with, thank you so much for all you do on the Oil Ground Up podcast. Justin Hune, an encyclopedia of what's going on in the uranium space and going nuclear. Just enjoy those episodes we do together. More of that to come in 2024. And Chris Berry over at The Power Current. Man, that is a great podcast if you're interested in the development of battery technology and the mining that is needed to power those that resource. So, Chris, you are one of the best. Thank you so much. And to thank you all the partners of the podcast, of MSD, throughout the year. Thank you so much for allowing me to do what I love to do. And because of you, I'm able to wake up each morning and share these stories and content with all the listeners. And speaking of listeners, thank you so much. This market this year wasn't great, but you kept coming back with interest in all the content interviews we produced. You kept coming back with ideas and follow-up questions, and you were always encouraging. So thank you from the bottom of my heart. Thank you so much. 2024, it's going to be even more exciting, I think, not just with the market, but with a couple of ideas we're developing here at Clear Commodity Network. And before I let you go for the next few weeks, I thought it would be a little fun to have a reading of a Christmas poem meant specifically for us who follow and dabble in these resource equities. And so with the help of artificial intelligence and adding a little bit of my own touch to the fray, I present to you a Mining Stock Daily exclusive titled, "'Twas the Night Before Drill Results." 'Twas the night before drill results, in the market so vast. Investors pondered uncertainties like the ghosts of projects past. Junior mining equities, a wild ride they knew, like sleigh bells jingling, prospects both old and new. Out in the bush, geologists with visions so bright mapped out the terrain under the headlights. Exploration hopes danced in the minds of the bold, yet risks lurked like shadows, stories yet untold. The drill bits whirled like Santa's sleigh in the sky, exploring the depths where treasures may lie. Investors nestled, their dreams intertwined, with assays of drill core, a roller coaster of the mind. Stock tickers flickered like holiday lights glow as portfolios shifted with each market blow. Gold and silver, like ornaments so fine, glistened with promise, yet danced on a thin line. The copper veins coursed a geologist's delight, and the market's grand symphony echoing through the night. Uranium, a silent power beneath the surface, a nuclear dance, potential with purpose. In the night's investment ballet, a cautious twirl, a radioactive waltz where risks might unfurl. Lithium, the lightest, a spark in trading's maze, batteries charged like festive candles ablaze. In the market's embrace, where innovation aligns, investors sought the future, where lithium defines. But caution, dear investor, as you navigate the night, for the market, like magic, can dim or shine bright. Junior mining equities, a tale to unfold, in the Christmas of investing, stories of nothing more than cheap paper and a market's stronghold. Thank you, everybody. We'll be back again early January. Have a happy holidays, Merry Christmas, Happy New Year. Love you to the moon. Thank you so much. Be well.